stock market has been seeing a flurry of activity after the Federal Reserve cut rates earlier this week. The S&P 500 hit its highest valuation ever yesterday. The impact of the Fed's decision to cut rates by 0.5 percentage point is also being felt in other sectors of the economy. For example, the average 30-year fixed mortgage rate in the U.S. dropped to just over 6% yesterday. CBS News senior business and tech correspondent Jo Ling Kent joins me now to discuss. So, Jo Ling, markets were slightly down this morning, but look, the Dow also closed at a record yesterday. What's happening here?
Look, there was a rally in response to the Fed's aggressive movement to cut by 0.5 point. A lot of investors and traders like to see that news. We knew going in it wasn't totally certain, and it seems that Fed Chair Powell and the entire FOMC minus one individual who dissented in favor of a 0.25 point cut are really looking ahead to drop the overall benchmark interest rate by a total of 1% by the end of the year. So what that means is we got that 0.5 point cut on Wednesday. And then on November and December, we have 2 more meetings coming up. We're expecting 0.25 point cuts at those meetings, totaling 0.5 point at some level.
So who benefits immediately from these rate cuts, or will it take some time for borrowers to feel some relief?
Well, I like that you brought up the mortgage rate because that's good news to see. And what we know is even though the benchmark interest rate is not directly tied to mortgages, it's been coming down for the last few months. So that's good news for people who are trying to make a decision on whether or not they get into the housing market, they refinance, things like that. So you're going to see more of that. The other thing I want to mention is credit card debt is going to be directly impacted by this. But so far, it'll hit in the next couple of billing cycles, this impact. But if you have if you're carrying $5,000 of debt on a credit card, for example, according to Bankrate, they tell us that this rate cut will only reduce that by about $2 a month. So it's pretty minimal there. And then when it comes to a car loan, say you've got a 5-year, $35,000 car loan that's a new car loan, you've got the new rate in place, you're going to get a relief of about $8 a month. So on the other side of it, though, of course, those high yield savings accounts, we're already seeing people get notified that those interest rates are going to drop, which means you're going to make less money on the cash that you're putting away.
What does this do to people's perception of the economy?
You know, it's interesting. It depends on who you ask. And so when you think about it, the rates coming down overall seems like, okay, 0.5 point, it's good relief. It might feel good to see that. But overall, what we see is inflation is already cooling off. So if your sensitive points are at the grocery store, food prices are going up, but they're stabilizing, right? But you're still feeling it in your car insurance. You're feeling it when it comes to rent inflation. Those are 2 things that are really driving that headline inflation number. But it really depends because it does take time for this stuff to trickle down to the consumer, so you may not feel this. In fact, most economists are telling us, look, you're not going to feel the effects of this before the election. And of course, the next Fed meeting and that Fed decision to cut or leave interest rates the same will come just hours after the election, after election day, I should say.
Also this week, unemployment claims hit their lowest mark in 4 months. Is that also a positive sign?
Yeah, we like to see that. We like to see unemployment claims stay at those lows, and we saw that basically, they're coming down. And what that really tells me is that the labor market in that particular metric is doing pretty well. When we asked Fed Chair Powell, all of us reporters, about the labor market, part of the reason that there was such an aggressive cut on Wednesday is because there is weakening in the labor market, in the jobs market. And so you've seen all those numbers get revised down for those monthly jobs reports. And that is something that the Fed is watching really closely. So the jobs market is weakening. We anticipate additional layoffs in the last quarter of this year. But Fed Chair Powell did tell us directly he doesn't see that to be major. And so looking ahead, it's a dance that the Fed is trying to do with what they call their dual mandate, right? Keep inflation down and maintain the strength of a healthy labor market. So it's a tough thing to do. A lot of people saying we're getting closer to a soft landing, but TBD on that front. Lindsay.
Okay, Jo Ling Kent, thank you.
Thanks.